Today, we are going to look at tax planning, tax audit, and tax investigation. Tax planning, tax audit, and tax investigation. So that is what we will look at today. Last week, we talked about introduction to taxation for the online student. Abi?
Yes.
Hello, good afternoon. Please,
Good
am I
afternoon.
the only person that cannot hear anything, or is peculiar to everybody?
I'm just coming up now.
But we can hear
I just
you.
started the lecture now. You can hear now? Hello?
Yes, we can hear now. I can hear you now.
Okay,
We just started.
okay.
Okay.
Yes. Okay. So we start with task planning. What do we understand by task planning? Task planning. What is task planning? Task planning involves taking conscious effort to consider the task that will be payable by taxpayer at a future date and how such tasks can be minimized. That is clear definition of task planning. The process of taking conscious effort to consider the task that will be paid by the taxpayer at a future date and how such tasks can be minimized is what? Task planning. How do we minimize how can a company minimize their tasks? You, as a task manager of a company, you will be planning for your company on how they can minimize their tasks. Task planning is not task avoidance or task evasion. No. What effort are you going to be making to ensure that the company task is minimized? So that is what task planning is talking about. That is what task planning is talking about. Sorry, just let me arrange this. My laptop is trying to is hanging. So I want to off it and on it back. Just give me like 5 minutes. That is task planning. Task planning. Now, let's look at task planning checklist. Task planning checklist that a company can design for their task planning. Let's look at task planning checklist. What are the checklists of task planning? Under the content of task planning checklist, let's look at it. Number one content of task planning checklist, we have the list of taxes and levies. When you want to design a task planning checklist for your company, you list out the various taxes and levies paid by your company in terms of what are the taxes and levies paid by your company to federal government, what are the taxes and levies paid by your company to state government, what are the taxes and levies paid by your company to local government. It will be part of your task planning checklist. Timing for fixed asset acquisition is another content of task planning checklist. Company will acquire fixed assets. Why do we need timing for fixed asset acquisition? So that we can take advantage of capital allowance. So that, because capital allowance is one of the task planning, we can use capital allowance to reduce our tasks. When we purchase capital allowance, when we purchase fixed assets, we are going to claim capital allowance. By claiming capital allowance, it will reduce our tax liability in the future. Timing of fixed assets disposals too. What time do we need to dispose our fixed assets? What time do we need to dispose our fixed assets? By disposing our fixed assets, we may be entitled to balancing allowance if we dispose it less than the tax written down value. Timing for capital allowance claim. What time do we need to claim our capital allowance? Is one of the content of tax planning checklist. Hire of assets or outright purchase of assets is one of the tax planning checklist. Do we need to hire assets or do we purchase the assets on outright? Hire of assets as alternative to outright purchase. Sometimes when we hire assets, we are going to pay interest on the hire cost or the rental cost. That rental cost can reduce, it's an allowable expenses. It will reduce your tax liability. You compare the hire of assets with outright purchase. When you purchase asset outrightly, you claim capital allowance. When you hire the asset, the rental cost is a disallowable expenses too. Which one is going to be benefit to the company most? Which one is going to reduce the company tax most? Is part of tax planning checklist. Withholding tax properly deducted. Deduction of withholding tax too is part of tax planning checklist. In your tax planning tax checklist too, you will state the date that you'll be filing your tax return. Filing of tax return is part of your tax planning checklist. Filing of notice of objection. Writing letter of objection to the tax authority in the case of tax audit is part of tax planning checklist. Payee monthly remittance. Remittance of your payee as at when due, which is 10th of the following month, is part of your tax planning checklist. VAT return and remittance. Remittance, filing of VAT return within 21 days of the following month and ensure that you remit the VAT dues is part of your tax planning checklist. National Housing Fund. Payment of National Housing Fund for your employee is part of your tax planning checklist, because in the long run, when you pay National Housing Fund for your employee, for each of the employee is going to reduce the tax that each of the employee will pay to the State Board of Internal Revenue, because it's National Housing Fund, National Health Insurance Scheme, Life Assurance Policy, Group Life Assurance Policy, pension contribution. They are tax exemption under personal income tax. They reduce the tax liability of an employee. So we have so many content of tax planning checklist. Consider current tax incentive. What current incentive do we have? You need to list that in your tax planning checklist. Pioneer companies too. Can our company enjoy pioneer status? You need to list that in your tax planning checklist. So when you look at the tax planning checklist, there are more than 20 under the tax planning checklist, the content. So, like I said, tax planning, they are the efforts that company can take or an individual consider that will reduce their tax in the future. Effort taken by the taxpayer at a future date, and it will minimize their tax. Opportunities that the taxpayer identify so that their tax liability in the future can be minimized. So we now have tax planning checklist. You can be asked, list 20 tax planning checklists, content of tax planning checklist. List 10 content of tax planning checklist. So in my study material, I have more than 10. I have like 20, even more than 20. So please take note of them.
Sorry, sir, please, will you share the material after class? Because I don't think we have it.
Presently, I've shared the material to the group chat. That is tax planning. The topic of today is called tax planning, tax audit, and tax investigation. We have looked at tax planning. Now, let's look at tax audit. Tax audit. Tax audit. Let's look at tax audit. What is tax audit? Tax audit is a specialized audit carried out by the tax official. Specialized audit carried out by what? The tax official. To determine the tax position of a taxpayer. So tax audit simply means a statutory or specialized audit that the tax official from the tax authority, they carry out the review of book and records of the taxpayer by the tax authority. That is what is called tax audit. The review or examination of book and record of the taxpayer by the tax authority during a given period of time. It is called tax audit. Objective of tax audit. Why do we need to carry out tax audit? Objective of tax audit. Why does tax authority carry out that tax audit? Why does tax authority review the book and record, the tax record of the taxpayer? Number one, to determine whether the accounting book and record exists for the purpose of determining the taxable profit or loss of the taxpayer. To determine whether the accounting book and record exists for the purpose of determining the taxable profit or loss of the taxpayer. Another objective is also to determine whether the tax computation submitted to the tax authority by the taxpayer agree with the underlying record, to determine whether the tax computation submitted to the tax authority by the taxpayer agree with the book and records. You know, taxpayer, they file return based on self-assessment. Taxpayer, they are the one that will compute the company income tax that they will pay, and they will go and pay it and submit report to the tax authority. Taxpayer, they are the one that will compute the VAT that they will pay on their sales. They will now pay it and submit the return to the tax authority. Taxpayer, they are the one that will compute the tax that they have paid on behalf of the employee, personal income tax. And at the end of the year, which is 31st of January of the following year, they will now file return to the taxpayer, to the tax authority. For company income tax, 6 months after the end of the year, they will file return, company income tax return to the tax authority. For personal income tax, 31st of January of the following year, they will file the return of last year. Take for instance now, for personal income tax, the tax that we remit for the tax that company remit for employee for last year, January to December, they must file the return, the record, the document for that tax, for that personal income tax. They must file it not later than 31st of January of this year. When, as we know, taxpayer pay tax based on self-assessment. Self-assessment means they are the one that they compute their tax liability on their own, and they now pay. Tax authority allow them based on trust. Go and compute your tax, pay. When you submit your report to us, it is when we now look whether the tax that you pay based on your record is correct or not. By reviewing the record after the taxpayer have submitted their return to the tax authority, by reviewing their record, they will carry out what is called tax audit. So one of the objectives of tax audit is to determine whether tax computations submitted to the tax authority by the taxpayer agree with the underlying record. Underlying record means the book and record of the taxpayer submitted to the tax authority. Another objective of tax audit is to determine whether applicable tax legislation have been complied with. What we are saying now is to determine whether that taxpayer, they normally comply with the tax legislation, which is the tax law. It is from the tax audit, tax authority will see whether taxpayer now, they are now applying withholding tax regulation. As we all know now, starting from this year, the withholding tax rate has been changed based on withholding tax regulation 2024, which is going to commence January 2025. If any of the taxpayers still using old withholding tax rate, it is during the tax audit, the tax authority will determine that this taxpayer, you have not been complying with the withholding tax regulation, the new one. Or the format used by the taxpayer to compute personal income tax, if it's not in line with the Personal Income Tax Act, it is through the tax audit that they will know. The format used by taxpayer to compute company income tax, if it's not in line with the Company Income Tax Act, it is through tax audit, tax authority will know. So, another objective of tax audit, to provide avenue to educate the taxpayer on various provisions of the tax law. To provide avenue to educate the taxpayer on what? Various provision of the tax law. So during the tax audit, you educate the taxpayer on various provisions, on the new changes in the tax law. You let them know, right now there is a new changes in the tax law. You let them know. Other objective, to discourage tax evasion. To discourage tax evasion is another objective of tax audit. During the tax audit, when you are reviewing the record of the taxpayer, you will see any of the taxpayer that is not paying the right tax. Once you know that they did not pay the right tax, you give them additional assessment. They will pay penalty. They will also pay interest. That one will discourage them from doing so in the future. So to discourage tax evasion is one of the objectives of tax audit. Another one, to detect and correct accounting and arithmetical error in the tax return. When you submit your tax return, if you have any error for that tax return, it is during the tax audit that tax authority will observe that and they will detect that. They will now correct it. You can make error. You can make error of omission, error of commission, error of transposition. To provide feedback to the management on various provisions of the law and recommend possible changes. To provide feedback to the management on various provisions of the law and recommend possible changes. During the tax audit, you will discover, you will interact with the taxpayer. Taxpayer will tell you their mind. Taxpayer will like you to know some of the weaknesses in the tax law. Taxpayer will like you, from there you communicate with them. You hear their own view on recent changes on the tax law. When you, as a tax authority, when you hear some of the taxpayer complaints during the tax audit, when you go back to your office, you table it to the management, to the top management, so that when they want to change tax law in the future, there can be possible changes in such an area. Another objective of tax audit, to identify involved tax fraud and recommend them for further investigation. During the tax audit, if any of the taxpayer is doing tax fraud, somebody that's supposed to pay a tax of 20 million naira, you now discover during the tax audit that he only paid 500,000. That one is tax fraud. And take, for instance, a company that deduct VAT from that charge VAT on its sales. VAT is not a company money, it's a government money. You charge it on your sales. Customer have paid the VAT. During the tax audit, tax authority now observe that this company, instead of them in a year to pay 20 million VAT, they only pay 500,000 VAT. That one is a fraud. That one, there is no remedy in that one. It's a fraud. What they will recommend, they will write a report that they should come and investigate you more. That means you have been, this tax authority, taxpayer, you have been doing that since. Tax audit team, they will now recommend to the management that they should come and do tax investigation. Tax investigation is more elaborate than tax audits. And when they are doing tax investigation, they will come with a law enforcement agency. Tax investigation is, they normally conduct tax investigation when they observe that you have engaged in tax fraud or tax evasion or tax criminal acts. Tax investigation, when they are doing tax investigation, they will come with law enforcement agency like Nigeria Police, EFCC, ICPC. Because during the tax investigation, the board of directors of the company may be arrested and prosecuted. So it is during the tax audit that they will identify whether you have committed tax fraud or not. If your sin is still minor, corrected during tax audit. But if you have committed a big tax offense, they will recommend further tax investigation. Another objective of tax audit, to encourage voluntary compliance. To encourage voluntary what? Compliance. When they are doing tax audit, it will make taxpayer to comply voluntarily to the tax law, because you know that at the end of the day, if I underpay my tax now, at the end of the day, they are still coming to come and check my bank statement, to come and review my record. If they observe that I've underpaid my tax, they will give me penalty. I will pay interest. So let me kuku pay the real tax now. Don't let me underpay tax. Let me pay my tax now as at when due. Voluntary compliance. So tax audit, we encourage voluntary compliance. These are the objectives of tax audit. So ladies and gentlemen, at least we need to know like 6 objectives of tax audit. 6 objectives of tax audit. We need to know that. 6 objectives of tax audit. Type of tax audit. Type of tax audit. There are 2 types of tax audit: desk audit and field audit. Desk audit and what? Field audit. Desk audit is also called desk examination. It is conducted based on tax return you submit every year. Desk audit is an examination of book and record of the taxpayer, carried out in the office of who? Office of Tax Authority. When they are doing desk audit, they will not come to the taxpayer office. They will review the record in the office of the tax authority. Tax authority will not go, they will not go out of the office. It is from the office that they will carry out the audit. Desk audit is normally carried out on the return that you normally submit every year. After you submit the return, they will now do desk audit on it. Desk audit is normally a 1-year audit on 1-year account. It is the office of tax authority that they will do it. They will not come to your office as a taxpayer. It is based on 1-year account you submitted to them. That is desk audit. It is also called desk examination. But in the case of field audits, in desk audit, taxpayer will write letter to you that you should bring your book and your documents, all those documents that you use for your tax computation, your bank statement, your sales invoice, your purchase invoice, evidence of payment of value-added tax, and evidence of filing, your withholding tax credit notes, your impress, your schedule of expenses. They'll ask you to bring it, the copy of the document to the office. It is from the office that they will review the record. And that your desk audit is based, they normally do it on 1 year report, 1 year tax report. The latest tax audit, tax return that you submit, that they will conduct desk audit on it. It is after the desk audit when they feel that you have if at the end of the desk audit, if they discover that you need to pay additional tax, they may warrant them, that one may warrant them to say, okay, let's go and do tax audit. If they are not certified with desk audit, they may proceed further to do field audits. What is field audit? Field audit is the review of book and records of the taxpayer. It is the comprehensive tax audit carried out in the office of the taxpayer. In field audit, they will come to the office of the taxpayer. They will come and visit them. So when they finish this audit, if they are not satisfied with the report, they can go further to do what? Field audit. In field audit, they will come to the office of the taxpayer. They will come and visit them. And the taxpayer will provide the supporting document for them to cite. And some of the supporting documents, they will take them along, photocopy. And another thing that involves field audits, most of the time, normally involve like 5 years review. They will review your tax report for the last 5 years, 3 years. Field audit is more than a year. If they come and do field audit, they will review your account for more than a year. The financial statement, the audited account that they will review to determine your true tax status, it will be more than 1 year account. It may be the last 5 years. So field audit is more elaborate and comprehensive than desk audit. It is carried out outside the tax office. It is carried out in the premises of the taxpayer. The examination of book and records of the taxpayer carried out by the tax authority in the office of the taxpayer. It is the field audit. If they want to carry out field audit, what are the stages involved in field audit? How does tax authority carry out field audit? What are the stages involved in field audit? Number 1 stage is selection of taxpayer to be audited. They will select the list of taxpayers that they want to audit. They want to conduct field audit for this year. Once they have selected the taxpayer that they want to conduct field audit for, that they want to audit, the next thing is preliminary review of taxpayer file. This you want to audit 20 companies in this month. They will carry out the file of that 20 companies. They will give it to the team, the tax authority staff that will go and audit. They will give it to the team. Please go and study this company file. This is the company you go and audit next month. They will review. By reviewing the tax audit file, taxpayer file, they want to get familiar with the record, the tax history of the taxpayer. They want to look at when is the last time they conduct tax audit for this taxpayer? What is the conclusion of the last tax audit that they conduct? How much does the taxpayer pay as an additional assessment during the last tax audit? Reviewing the taxpayer file too. Does this taxpayer normally file the return as at when due in terms of value-added tax return, in terms of withholding tax return, in terms of company income tax return? After that, notification of the taxpayer. After they have studied the taxpayer file, they will now write a letter to the taxpayer. That is the next stage. They will write letter to them, notifying them that, we are coming to come and conduct tax audit. And when it is the tax audit is going to be conducted in so dates, please try to gather all the relevant documents. They will list out the document that they will need for the tax audit. Please try to gather it down. So after that, pre-audit meeting. Before they start the tax audit, in the date that they propose to do the tax audit, they will now do pre-audit meeting. Meeting the head of the company, the board of directors, or the management of the company. They will introduce themselves to the management and they will tell them the reason why they are here. Immediately after they do the pre-audit meeting, they will start the field audit. They will be reviewing the book and record of the taxpayer. After they finish the field audit, they have finished the field audit. They will now do post-audit meeting. Post-audit meeting will be conducted. Is the next stage. Telling them that we have finished the audit. This is what we discovered so far. These are the outstanding documents your company is here to provide for us. So before we conclude our report, we are giving you 2 weeks. Please try to send this document to our office so that we can use it to conclude our report. After post-audit meeting, they will now prepare interim audit report. Interim audit report means the tax report, additional assessment that they discovered during the tax audit. They will prepare that. In the interim audit report, they will submit it to the head of the tax audit. The tax team, the tax authority team that went for the tax audit, they will submit the interim audit report to the head. The head will review it. Once the head will review it, they will now send it to the taxpayer. Once taxpayer receives the audit reports, they will invite the taxpayer for reconciliation meeting so that they can reconcile some of the area that the taxpayer feel that is not right, so that they can explain if need be. During the reconciliation meeting, taxpayer will come with some of the documents that he feels that they have not incorporated in the tax audit report, so that the tax liability arising from the tax audit will be reduced. After reconciliation meeting, the next thing is final audit report. They will now send final audit report to the taxpayer. This is the final assessment we have discovered from this tax audit. This is the final tax liability that you need to pay from this tax audit. So, final audit report. When taxpayer receives the final audit report, he has a right to write letter back to the tax authority to defend the final audit report that You are saying that I should come and pay additional liability of 41 million. No, this is not, I can't pay this liability because I'm not owing it. This is my document. This one that you said I need to pay tax, this one that you record as an income to me, as a revenue to me, that I need to pay additional tax on it. It's not a revenue, it's a director lodgement. Taxpayer will now be they will now started argument with supporting documents. Right. So these are the stages of feed audit. Stages of feed tax audit. You may be asked, what are the stages of tax audit? They are referring to stages of feed tax audit. Number one is selection of taxpayer to be audited, preliminary review of taxpayer file, notification of taxpayer, that is next, pre-audit meeting, followed by feed audit, post-audit meeting, interim audit report, post-audit review by regional head of audit, reconciliation meeting. After the reconciliation meeting, final audit report. Now, we want to look at some of the stages one by one. Some of those stages, we want to look at them one by one. Selection of the taxpayer to be audited. How does tax authority select taxpayer to be audited? If they want to select taxpayer that they want to audit, what are the criteria tax authority use to select taxpayer to be audited? Selection of the taxpayer to be audited. Selection of the taxpayer to be audited. That is where we are. We want to look at stage one of the stages involved in the tax audit. Selection of the taxpayer to be audited. What criteria does tax authority use to select taxpayer that they want to audit, that they want to conduct tax audit for?
Hello, sir.
Yes, sir.
Sorry, I just want to know, sir, like you earlier mentioned that DEX audit is yearly activities, well, field audit is either 3 years, 4 years, or 5 years. Assume, is it, even if the audited company or through that DEX audit, and if you have been complied with throughout the year, maybe other 2, 3 years you have been doing the DEX audits, are they going to also conduct the field audit on your company?
Yes, they will conduct it.
Okay.
Yes, they will conduct it. They will conduct it. It's mandatory to conduct field audit, even despite that they have done desk audit. If they have done desk audit and you pay additional liability, during the field audit, you let them know that they have conducted desk audit. But when they are doing the field audit, if they are conducted for desk audit, it will make the work to be easy. Do you understand? The report of the field audit, the team of the desk audit, the report of the desk audit, the team that conduct the field audit can adopt it when they feel that this report is right, and they will look at the additional assessment you have paid from the field audit. Do you understand?
Yeah, okay, thank you.
So what criteria do we use to select, tax authority use to select taxpayer to be audited? Number one is self-assessment taxpayer. When you are doing self-assessment, you are the one doing your tax by yourself, computing the tax liability you pay by yourself as a company. That is how companies do. Tax authority allows self-assessment. Our company income tax, personal income tax, value-added tax is based on self-assessment. It is the taxpayer that will compute their tax by themselves. Because taxpayers are doing self-assessment, they will now say, for the last 2 years, which company, any company that have submitted their self-assessment for the last 2 years, can we go and audit them? They can use that criteria. They can use self-assessment taxpayer as a criteria to select taxpayer to be audited. Another criteria is taxpayer with refund claim When a taxpayer write a letter to tax authority that, I want to claim refund, tax refund, you know the meaning of tax refund. When taxpayers feel that they have overpaid tax or they have excess of withholding tax credit note, and they now write a letter that tax authorities should come and give them balance, they should come and pay them money, that they have overpaid tax and they have excess of withholding tax credit. You are the one that you are looking for trouble, you taxpayer. You write a letter of tax refund. Before tax authority can grant your refund, they will conduct tax audit. They will go and examine your report, whether you have paid the right tax or not. And I'm telling you, in practice, there is no, even the multinational company, though they are trying, most of the multinational companies, they normally comply with all the relevant tax law. They don't short-change tax. But there will never a time tax authority go to do tax audit, go and do tax audit that they will not discover additional assessment. One way or the other, you must pay additional assessment. So one of the criteria is any taxpayer that requests for tax refund, taxpayer with refund claim, they will conduct tax audit on them. Another criteria. What are the other criteria? Taxpayer with nil return or continuous loss situation. Every year, when taxpayer is filing return, they normally file a new return. There are some taxpayers every year, they will say they are not yet commenced business, or in that year, they did not make any turnover. If they want to file company income tax return, they will file new return. They will not pay company income tax. They will say their turnover is too low. They will not pay company income tax. This one also applicable to some company where while they are filing VAT return, they will be filing zero VAT return. They will not pay any VAT. They will say they did not make sales in that month. If tax authority observes that in the last 5 months, 6 months, you have been filing new VAT return, you do not pay any VAT, you say zero, zero, zero. That one can warrant them that this company that have been paying tax before, why this company now started filing zero VAT return? Does it mean in the last 6 months, this company does not make any sales? Please, let's go and do tax audits. Continuous loss situation. When a company, when they prepare their financial statement every year, they normally reported loss. They make loss in year 1, year 2, they make loss, year 3, they make, every year they normally make loss so that they will not pay tax. That one can give room for tax authority to conduct what? Tax audit. Another criteria for selection of taxpayer. Taxpayer with very low adequacy ratio. When the adequacy ratio of the taxpayer is very low, when they do the adequacy ratio, when they look at your revenue compared to the tax you pay, is very low, they will go and conduct tax audit on your report, on your account. Another criteria, based on routine industry check, they can say, we want to audit all the company in oil and gas. For this year, we want to do special audit on all the company that fall under oil and gas. Next year, any company that fall under HMO, Health Management Organization, we need to audit them. Upper year, insurance company, we are going to audit all the insurance company in Nigeria. That is based on routine industry check. Another criteria for selection of taxpayer to be audited, when they receive intelligence information from the external source that this taxpayer, they are not paying the right tax, or they are underpaying tax, they receive intelligence information. Maybe from the staff of the company, maybe the company staff, one of the finance staff that normally help the company to do tax shenanigans. Suddenly, the company sack the staff. He will be the one to go to tax audit that, this company, they have been underpaying their tax for the last 5 years, for the last 10 years. I have some key information about them. I can help you in order to do payback. Once they receive intelligence report, intelligence information about that company, they will go and conduct tax audit. It's one of the criteria. It's one of the criteria. So we have so many criteria which they can use to select tax payer. They can do random sampling. They will just list the company. They will say any company that their name starts with S, we are going to audit them this year in our tax audit office. In our tax office. Random sampling. It can be as a referral from the desk audit team. Desk audit team may refer that tax audit, field audit, please come and conduct tax audit on these people. The 1 year desk audit we conducted on them, we see a lot of underpayments. That means this company, if we conduct further for the previous year, you will see a lot of tax evasion in the record of the company. So there are a lot of criteria that can be used. Directive from higher government authority. Higher government authority can give directive. State government can give directive that, LRSO, go and conduct tax audit on this big company. I want to know the real tax that they are paying for the employee. Federal government, Ministry of Finance can give directive that, please, go and conduct tax audit on Dangote group of companies. I want to know their real tax. Directive from higher government authority. So we have so many criteria that is used to select taxpayer to be audited, which I've mentioned. So as a good student, you should know at least 7 criteria that can be used to select taxpayer to be audited. Now, we are still on tax audits. We have talked about tax audit. We said there are 2 types of tax audit: desk audit and field audit. The most important one, when we are talking of tax audit, we are referring to that field audit, because field audit is more comprehensive than desk audit. We have talked about stages involved in field audits. And one of the stages is selection of taxpayer to be audited. We have looked at the criteria that we can use to select taxpayer to be audited. Now, the next thing we need to look at now is tax audit checklist. If you want to go and conduct field audit, what are the checklists that tax authority will have to do while doing the tax audit? What are the checklists that tax authority they have to do while doing the tax audit? Number 1, name of the company. They have to write the name of the company. The register address of the company is part of tax audit checklist. Business address. You have to note the business address of the company. Date of incorporation of the company must be noted too. Date of commencement of business. Which date does the company commence business? Date of incorporation may be different from commencement. A company may incorporate 5 years ago and they just commence business now. A company, they may be incorporated 5 years ago and just commence business now. tax file number, the tax identification number of the company, the nature of business, what kind of business this company is doing. You have to know that as a tax authority. It will be part of your tax audit checklist. External auditor of the company, the name of the external auditor or tax consultant of the company. You need to know that. And the address, the bank, the name of the bank that company is using, either First Bank, Zenith Bank, you need to know that. Their share capital, the authorized share capital, and their issue share capital. The shareholding structure, you need to know their shareholding structure. Who are the majority shareholder of the company? The name of the director, you need to know the name of the director. It's part of tax audit checklist. The accounting year end of the company, you need to know that. The period covered during the last tax audit. When they do the last tax audit, how many years period that they do? You need to know that. So tax audit checklist is very important. Like I said, in your tax audit checklist, number one content of your tax audit checklist is name of the company, register address, number 2, business address, number 3, date of incorporation, date of commencement, tax file number, nature of business, external auditor, the name of external auditor and tax consultant of the company, and the address, the office address, the name of the banker of the company, the name of the company legal advisor, and the company secretaries too, the share capital structure of the company, the authorized share capital, the issue share capital, the shareholding structure, who are the shareholder of the company, who are the majority shareholder, the name of the directors too, you need to know that. So these are the tax audit checklist. These are the tax audit what? Checklist. Now, what are the list of documents? If FRS want to conduct tax audit, what are the list of documents that they will require from the taxpayer? The list of required documents for FRS tax audit and investigation exercise. If FRS want to do tax audit exercise or investigation, what are the list of documents they will ask the taxpayer to submit? Number 1, audited account for the relevant year. If they want to do tax audit for 5 years, they will ask them to give them the copy of audited account for the last 5 years. Audited account is one of the list of documents. Management account for the relevant year. Management account too is part of the list of documents that they will ask. Chart of account too. Chart of account, they will ask that. They will also ask them to provide their trial balance for each of the year. General ledgers too. They will ask them to submit their general ledger. They will also ask them to do what? Submit audit adjustment journals. When the external auditor come and audit the company, the adjustment journal external auditor rates, tax authority will ask, give us. Sales invoice, copy of the sales invoice. They will ask them, or the sales invoice file, they will give them, they will ask them to provide the sales invoice file for them to review your sales. Purchase invoice file too. They will ask for your purchase invoice file. Payment voucher file for bank and petty cash payments too. They'll ask, give us your payment voucher so that we can look at the list of those who you make payment to and how much do you pay to them. Import documents too is part of the list of required documents. They will also ask fixed asset register. what is your fixed asset register? Give us your fixed asset register so that we can look at your schedule of fixed assets, so that we can look at the assets you acquire for each of the year, so that we can know that truly you can claim capital allowance. They will also ask, please give us your value-added tax file, so that they can detect how you remit your VAT on a monthly basis. They also ask evidence of input VAT claim. They also ask for withholding tax file. All these are the list of documents that they will ask during the tax audit. There are a lot of documents tax authority will ask, which is FRS. I'm referring to what? FRS. Minute of board meeting. They will also ask that. Stock counting reports. During the stock counting, your stock counting record, they will ask. FRS will ask. Rent agreements too. Your office, if it is rented apartment, they will ask for your rent agreement between your office and the landlord. So there are so many documents that they can ask. FRS will ask the taxpayer to provide during the tax audit. So, ladies and gentlemen, it is good to know at least 20 documents. Out of all these documents I mentioned, it is good to know at least 20. It is very easy. Sales invoice file, purchase invoice file, fixed asset register, value added tax file, bank statements, payment voucher, audit journal, audited accounts, chart of accounts, trial balance, stock reports, rent agreements, valuation certificates, contract agreements. So those are the documents that they will ask during tax audit. All these documents, they are required by FRS if FRS want to conduct tax audit. Now, let's look at the list of required documents for SRS, State Internal Revenue Service tax audit. If LRS, which is State Board of Internal Revenue, want to conduct tax audit, what are the list of documents that they will ask from the taxpayer, which is from the company? For the one of states, they will ask your copy of audited financial statements. They will also ask for your general ledger and trial balance. For states, they will ask for your staff lists and their designation, the list of staff of the company and their position, which is designation. They will ask for your payroll for your local staff, payroll for your expatriate staff, in case you have expatriate as a company. Because if state want to do tax audit for company, they want to look at the personal income tax that the company remitted for their employees. Is it the right personal income tax? So that is the reason why they are concerned about staff. Payroll, they'll ask. They'll ask for your schedule of company vehicle. They'll ask for the analysis of staff costs. How do you get the staff costs in the audited financial statement? Give us the breakdown. What comprises of the staff costs? Does the staff cost comprises of pension, gross salary, NHF, NHIS? They will ask evidence of registration and remittance of pension, because pension is used to reduce personal income tax. It's one of the tax exemptions that is used to reduce personal income tax. They will ask, if you are using pension to reduce your staff personal income tax, give us evidence that you register your staff with a pension company, PFA. and give us evidence that you have been remitting the pension. They'll ask that. Evidence of registration and remittance of monthly remittance of NHIS. NHF, National Housing Fund. National Housing Fund too is one of the tax exemption, is used to reduce tax. Evidence of remittance of National Social Insurance Trust Funds too. They'll ask for evidence of remittance and registration. They will also ask for schedule of local and expatriate payee tax paid. The schedule of tax you pay for your local staff on a monthly basis. For the month of January, how much do you pay for your local staff? For the month of February, how much do you pay for your local? You give them the schedule. For your expatriate staff too, you give them the schedule. Employee contracts of both temporary and permanent expatriate staff. They'll ask for the employee contracts. If you have any temporary or expatriate staff, give us the contract agreements. Letter of expatriate quota for the company. The expatriate letter that they receive from immigration office that they are entitled to work in Nigeria and the number of days, the number of years that they will spend in Nigeria. Give us. Copies of expatriate deletion form. When any of the expatriates that you employ to your company in Nigeria, they want to leave Nigeria, they have to fill a form called expatriate deletion form from the immigration that they are no more in Nigeria. You give them the copy so that they know that they are no more in Nigeria, so that they will remove them from the payroll. They will not be computing tax for them. Payment advice. When you want to pay your staff salary, the payment advice you normally raise to bank, they'll ask for the copy. List of your contractors, your supplier, those who supply you your consumable, your goods. Or everything that you are using in your company, the contractor that supply you, you give them the list. Payment voucher for the period under review. You give them a copy of your payment voucher. When you are making payment voucher to people, when you are making payment to people, the voucher you raise, you give them. The rent schedule and the rent agreement, your office, the rent schedule, the rent, how much do you pay for the rent of your office, and the rent agreement, if the office is a rented apartment. The name and address of the directors to give them. The schedule of payment made to the director, the payment you made to the directors, you give them the schedule so that they can know whether the director paid the right tax or not. The copy of business premises registration, the evidence of business premises that you pay for your company. You pay business premises every year to LRS. It is 5,000 for an existing company. For new company, it's 10,000. Evidence of that payment, the receipt of your business premises, you show them. The receipt of your development levy. Development levy, you pay it by your staff. It is 100 naira per staff. You show them the receipt. Every year, you must pay development levy for each of the staff you employ. You show them a copy of tax clearance certificate of the director. The tax clearance certificate given by the State Board of Internal Revenue to the director. You show them the copy. These are the list of required documents for State Board of Internal Revenue Tax Audit, State Internal Revenue Service. If they want to do audit, like LRS, if LRS want to come and do tax audit in your company, the list of documents that they will require, these are the list. We have mentioned the one of FRS. We have also mentioned the one of what? LRS. So hope this is clear. Hope this is clear. That is what we have on tax audits. That is what we have on what? Tax audits. Now, the topic is tax planning, tax audit, and tax investigation. We have talked about tax planning. We have talked about tax audit. Now, let's go to the last one called tax investigation. What do we understand by tax investigation? Tax investigation. Tax investigation is carried out when a taxpayer is suspected to have committed tax fraud. Tax investigation is carried out. It's more elaborate than tax audit. It's carried out when there is suspicious cases of tax fraud. It is carried out by tax authority too. When there is suspicious cases of tax fraud, when they discover that taxpayer is engaging in tax fraud. What is tax fraud? Value-added tax that you charge on your sales as a company. You don't remit it to the FRS, or you under-remit it. That is tax fraud, because value-added tax is not your money. You fail to file tax return as at when due. That is tax fraud. Or a company has been in business for more than 20 years, 10 years. They now discover that they did not register for tax. For the 10 years that they have been operating, they have been doing business, they have not paid down as tax. That is tax fraud, failure to register for tax. Let me give a typical example. Maybe one of the directors of FRS went to a supermarket to go and buy good. They now see that this supermarket is doing well. It's one of the popular supermarkets. They now look at the receipt given to them, printout of the payment that they make. They remove VAT. This company is making well, is doing well. That means every month they will be remitting like 20 million VAT or 30 million VAT. The director now go to the office next day. He now one of the staff, please let me check the record of this company. How they remit as a VAT every month. The staff now check, Oga, I've checked the record. I discover they did not, this company is not in the tax record. This company has never been paying tax. That one, they cannot do tax audit. It's tax investigation. They have committed a fraud. They have to arrest the director of the company, the owner of the company. This company that normally did not VAT. This company, they just registered, they just have TIN number. They have not paid tax. They have not started paying tax. And they are deducting VAT. That one can result into tax investigation. Suspicious cases of tax fraud. Tax investigation is conducted. It's an examination of book and record of the taxpayer. Conducted when there is suspicious cases of what? Tax fraud or tax evasion. Because tax evasion is a criminal. It's criminal. It's illegal way of not paying tax by falsifying your record. Sorry, the network is very bad. Objective of tax investigation. Objective of tax investigation. What are the objectives of tax investigation? Most of the staff of tax authority that conduct investigation, they are specialists. They are well trained on anything that have to be. Most of the staff that do tax investigation, they are a specialized investigator. They are special. They give them a special training, and they have more knowledge on forensic accounting, forensic audit, forensic investigation. Tax investigation team, they cannot just engage any tax authority to come and do tax investigation. They are well trained. They treat them specially. And tax investigation, when tax authority are doing tax investigation, they normally go in line with the tax law enforcement agents. Sometimes Nigeria police will assist them. Now, what is the objective of tax investigation? Objective of tax investigation. Number one, to detect tax evasion and other breaches of tax law. To detect tax evasion and other breaches of the tax law. Another one, to determine and recover the tax losses resulting from the breaches. During the tax audit, tax investigation, the investigation team, they will recover all the money that you did not pay as tax. Tax investigation team can say they will write bank to place lien on your account so that you cannot withdraw money. Tax investigation team, they can come to your, when they are in your office, they will place ban on your properties so that you cannot take any property out of that company again. Because some of the property, some of the car, vehicle, major asset of your company will be seized during the tax investigation. Your company may be locked during the tax investigation. They will lock up the company during the tax investigation. To identify and apply penalties, sanctions imposed by the law for the breaches is one of the objectives too. To provide sufficient evidence of the breaches of the tax law is one of the objectives of doing tax investigation. To identify avoidance and recommend changes to the process is one of the objectives of tax investigation. To identify cases of tax fraud and obtain evidence for possible prosecution. At the end of the tax investigation, the director of the company will be prosecuted in the court. Tax authority will take them to court. They will prosecute them. Some of them will be jailed because they have committed a fraud. So all these are objective of tax investigation. Now, what are the circumstances that may trigger tax investigation? What are the circumstances that may trigger tax authority to come and do tax investigation? Failure to register for tax. They discover that this company, they have started business. More than 2 years, they have not registered for tax. They will come and conduct tax investigation. Failure to file tax return. As a company, you have registered for tax. You fail to file tax return. And tax authority write a letter to you to desist from the act of not filing tax return. You continue. Failure to allow access to book and record. When they come to a tax audit, they want to do tax audit. They are in your office. You do not give them the required document. Those documents that we mentioned earlier during the tax audit, they come. You do not give them any document. They just sit down. You do not give them any document. You do not entertain them. You do not attend to them. The tax audit team, they will just go back to their office and write a report. They will now send the report to investigation. The next thing, it is the investigation week. And when the investigation comes, they will not come alone. They will come with law enforcement agents, Nigeria police, EFCC, ICPC. So you will not say you want to deprive them. You allow them to enter. So if you refuse to give book and record to the tax authority during tax audit, you are calling for tax investigation. It will trigger tax investigation. Another one, abuse tax scheme or aggressive tax avoidance scheme. You are doing tax avoidance. You don't want to pay tax. You identify loopholes in the tax law, but you now abuse it. It will call for tax investigation. Suspicious of tax fraud. They suspect that you are committing tax fraud. You are understating your income. You are overstating your expenses in order to reduce your tax. You are falsifying your sales. They will come and do tax investigation. Denial of access to tax audit exercise. During the tax audit exercise, your company is one of the big oil companies. You now say, tax audit exercise team, please, you cannot allow to enter our office. We are doing one meeting now. You have to come back. And they have written a letter to you before that they are coming for tax audit so day. You deny them access to your company. You don't allow them to enter. The security says, okay, the MD said they don't want to entertain any outsider now. Then that it is tax audit team. We are from FRS. We want to come and audit. MD say nobody should enter. Please start going. Please help us call your CFO, your director of finance. Tell them we are outside. They say they don't want to see anybody. You can go. You deny them access to your company. What they will do is to give your name to tax or the tax investigation team. Tax investigation will come. And when tax investigation come, even if you are a Chevron, you allow them to enter because they will come with law enforcement team. They will come with police and police because they know that anything can happen or they want to arrest anybody. So they have a right to enter. Another reason that can trigger tax investigation, regulatory authority sanction of the taxpayer. Maybe one of the bank is sanctioned by CBN that they are going against the prudential guideline. They are not following the CBN rule. That one too can call the tax authority that this company that is going against prudential guideline. That means they may be evading tax too. Let's go and do tax investigation. Non-remittance of taxes collected on behalf of tax authority. You collect tax on behalf of tax authority, example, value-added tax, you do not remit it. Negative media tax report on the company. You are reading a news, media, news, negative news about the company, how the company commit a lot of offenses, how the company engage in a lot of criminal activities. When tax authority officials are reading news about such company, that one may warrant them to go and say, let's go and do tax investigation. This one have beyond tax audit. This one have gone beyond tax audit. Let's go and do tax investigation on them. Whistleblower on tax evasion. You receive a whistleblower, a report about the company that they are engaging in tax evasion. You go and do tax investigation. Refer from the tax audit or law enforcement agency. You receive a letter from the tax audit team that this company, we have done tax audit on them, we are not certified. Tax investigation team, go and do investigation. This one are beyond our own boundary, tax audit boundary. Go and do investigation on them. Or law enforcement team, the law enforcement, like EFCC write a letter to you that please, they receive a report from the staff, one of the staff of the company, that this company is not paying the right tax. Go and audit them. It is tax investigation they will go and do. So all these are the circumstances that trigger tax investigation. Hope this is clear. Any issue, any query? Do you understand? So the next thing we need to look at now is differences between, let's look at stages of tax investigation. What are the stages of tax investigation? Stages of tax investigation. What are the stages of tax investigation? Number one, surveillance or pre-investigation activities. You have to carry out surveillance. Tax authority, before they go and do tax investigation, they will carry out surveillance on the company. They will disguise as if they are not a tax authority. They will go to the company to go and be collecting some insider information, reports about the company. After you have gathered enough information on them, and you have seen clearly that this company have engaged in an offensive that warrants investigation, you will now notify them. You need to notify them that you are coming for an investigation. But when you notify them, that notice must be short notice. It will not be a long notice. A week before you are coming to the investigation, you will notify them. Unlike the tax audit, if they want to do tax audit, 3 months before the tax audit, they will have notified you. But in the case of investigation, it will be a week. Because if you go and notify them, if the notice is a long period, the company may fold. They may decide to wind up the company before you come. The director of the company may japa. You won't give them long notice. It is a short notice you will give to them that you are coming for tax investigation. Do we understand? Do we understand? After the notice, pre-investigation meeting, before you start the investigation, you have a meeting with them. The managing director has to be in that meeting, and the financial director has to be in that meeting too. You inform them the purpose of the investigation, and you confirm the background information you gather about the company. You tell them that this is what you gather about them. You familiarize yourself with the company accounting system in the pre-investigation meeting. You ask them that they must cooperate with you, or if they don't cooperate with you, you need to report them to the law enforcement agents. And you let them know that this investigation, if care is not taken, some of them can be prosecuted if they not give you the right information. After the pre-investigation meeting, evidence of investigation. You need to gather evidence. During your investigation exercise, you now be gathering evidence. During that evidence of investigation, you may arrest one of the officers, especially the CFO. Is the chief one, is the one that helped them to be arranging book, that helped them to be minimizing tasks. CFO, accountants, they are the one encouraging company not to pay tax, to engage in criminal acts, to evade tax. They are the one helping company to falsify record. You need to arrest them. You secure warrant of arrest. By the time you arrest one of the 2 officers, the other one, they will try to cooperate. And you need to let them know that in case if any of them want to show something smart. You understand? The major directors too will be arrested. So you now prosecute them. Once you gather evidence that truly they have engaged in tax fraud, you prosecute them. You prepare case preparation. You take them to court. Case preparation. You started your case. You gather your evidence. You are preparing to take them to court. After that one, you arrange them. You arrange them for criminal prosecution, because tax fraud is a criminal. It's criminal. Arrangement. You arrange them to court. Court will decide. When you arrange them, we take them to court. Court will decide. Termination of the investigation. It is court that will terminate the investigation, that will tell them whether the company should be fold up, the company should liquidate all the money in the company, the bank account, whether they should pay it to the tax authority. It is court that will decide. The end result of tax investigation lies with the court. It is court that will decide whether truly this company have engaged in tax fraud or not. But the problem we have is, at the end of the day, when you take them to court, you know how long court normally decide the case. When the director have committed fraud and they have committed criminal, at the end of the day, if the director is very, very popular and if he knows his way, by the time they will say this offense is bailable, they will bail them. They will be coming from, at the end of the day, they will be proceeding the case, postponing the case. So it will take a long period of time before they will decide. So that is termination of investigation. That is stages in tax investigation. So the next thing we need to look at is differences between tax audit and tax investigation. Differences between tax audit and tax investigation. We may be asked, differentiate between tax audit and tax investigation. Tax audit is a routine exercise. It's legally required as a routine exercise that every 5 years so we need to be auditing this company to know whether this tax they are paying is right. But tax investigation is not a routine exercise. Tax investigation can be carried out when suspicious cases of tax fraud is established. That is one of the difference. Another difference is tax investigation scope is more wider. The scope of work in tax investigation is wider than what? The one of what? Tax audit. Tax investigation scope is wider than the one of tax audit. That is another difference. Another difference is tax investigation will be carried out when a taxpayer is suspected to have committed fraud. But when you want to carry out tax audit, it is not necessary when you discover that they have committed fraud. It's routine. It is required by the law that you should do tax audit. Tax investigation is conducted by tax inspector who have special training and competence in investigation techniques. What we are saying is the tax investigation team, they have a specialized training and knowledge. But for the tax audit team, they don't need specialized training and knowledge. The end result, another difference is that the end result of tax investigation is possible prosecution. Possible prosecution. But the end result of tax audit is to give them additional assessment to pay. Hope my differences is clear. The end result of tax investigation will be possible prosecution of the taxpayer, while the end result of tax audit is additional assessment. Do you understand? Do you understand?
Oh, yeah.
So those are the difference between tax investigation and tax audit. Please, let's know the difference. Let's take note of the difference. Now, the last area we need to know, tax enforcement procedure. If you want to enforce a law, you have discovered that this tax authority, taxpayer is not paying the right tax. You have gave them assessment. After the tax audit, you have gave them additional assessment. They did not pay. You have sent them a reminder notice. They did not pay. How do you do tax enforcement? How do you enforce the law against them? How do you enforce that assessment against them? When you finish conducting your tax audit, you give them assessment, they do not pay. How do you enforce the company to comply with the payment, to make the payment of additional assessment? Tax enforcement procedure. What are the methods? What are the procedures that you enforce tax law? Number one is distrain on the taxpayer good. You place warrant of distrain on the taxpayer good. Some of the good that they are selling, you seize them, you distrain them. You seize some of their good that they are selling. You go to their office, you place distrain on the good. That means they cannot sell the good. You have seized the good as a tax authority. I want another one. Distrain upon the land. You seize their land or building, premises owned by the taxpayer, their property. You seize it. You place warrant of distrain on them. If you place warrant of this, that means they cannot do anything. Another one is, after the tax audit, they did not pay the money. FRS can sue them to the tax law, to the court. They can sue them to the court of law. They can sue them. It's one of the tax enforcement procedure. Some of them, if they have vessel, you can place warrant of distrain on their vessel. So that you can recover your tax from them. You would notify. So now, if you place warrant of distrain on any of the good or property or asset of the taxpayer, what are the content of that warrant of distrain? You name the name of the officer that placed the warrant of distrain, the name of the tax officer that placed the warrant of distrain, the name of the company, the name of the taxpayer, the amount of tax level on them that they do not pay. During the tax audit, you say that you come and pay additional assessment of 60 million, and they did not respond to you, they did not pay. After like 3 reminder letter, more than 2 years, you name that they are owing you 60 million. They are owing tax authority 60 million. The year of assessment, the year that you conduct the tax audit, the amount due for the year, and that warrant of distrain must be signed by the chairman of the board of the FRS. In the case of FRS, if it is SRS, if it is state, it must be signed by the chairman of state board. The date of signing too must be stated. So these are the content of warrant of distrain. So ladies and gentlemen, this is where we are going to stop today. This is what we need to know on tax planning, tax audit, and tax investigation. Any question, any query, any observation? Any question?